Welcome to our meetup tonight, and we're going to be talking about a real life case study, which is great. And if you're listening to this as a podcast, welcome. We're going to be talking about a case study of a self-storage that we built or that we bought just in early 2019, and we're going to kind of go through not just the deal itself, but we're going to go through what I would look for personally in investor documents. So, if you were looking at a brand new self-storage or multifamily or a syndication, what would you look for in the offering documents if you were trying to make a decision on doing that deal? And, what looks good, what looks bad, what are the things that I sort of look for if I was passively investing in a syndication. So my name is Ryan Gibson, and I'm with Spartan Investment Group. And tonight, I also have Tyler Thomas here at Igor, who helped me do the meetup, and we'll go ahead and get started. So the reason why we have this meetup and podcast is we want to increase passive investor sophistication. We want to start a network and eventually provide quality opportunities, project site visits, and basically to enhance and passive investor knowledge to those that are thinking about doing a syndication and or who are already doing syndications that want to learn how to do it even better. What is a syndication? We kind of go over this quickly. It's a pooling of investor dollars to take down a larger asset. So if you ever want to go out and buy a 300-unit apartment building, it might cost $20 or $30 million. Really hard to do by yourself unless if you're absolutely loaded or rich. But if you invest in a syndication, you can own a piece of that. And furthermore, you wouldn't need all the experience. So syndications can do anything. They can buy anything from a conglomerate of single-family homes to thousands of units of self-storage. So just some disclaimers, for tonight. This is a closed offering. This is not a general solicitation. Obviously, I'm not giving any financial or legal advice. Seek your own outside counsel, and do your own due diligence. So, this is just for friendly conversation, for a nice networking and podcast experience. So definitely do your own due diligence before doing anything investment-wise. So tonight, this is the case study. It's probably one of my favorite deals. We did it last year in the spring of 2019. And it was a self-storage facility south of Dallas, about 45 minutes south of Dallas, Texas. And it came with 11 buildings of storage, a 5-bay car wash, vacant land for expansion, and a U-Haul truck rental business. The facility was pretty much full, and it had acreage that we could expand upon, which is what we liked it. We picked it up for $6 million, and the day we bought it, there was about $443,000 of NOI in place. So tenants were renting and paying bills and doing car washes and renting trucks. And that effective cap rate was about a 7.38, which is pretty high for storage. That's a really good cap rate for a storage facility this size, about 80,000 square feet. And the reason why the cap rate was a little bit higher was because of the way the car wash was valued. When you took the car wash cap rate and the storage cap rate, kind of smashed them together, the car wash cap rate was much higher, and the self-storage cap rate was much lower. Typically, in this time of a market, you see anywhere from 5.5% to 6.5% cap rates in this market for storage of this quality. I always like to talk about, the first thing I look at in a syndication is what is your total project cost? So how much money is needed to get the deal done? And, when I'm looking through the offering memorandum, this is kind of where my eyes go first. How much money is going into the deal? So in this case, it was $7.5 million. And then how is that money being obtained, and who is providing that capital? So I look at the capital stack, and that's the thing to the left. In this case, we got $5.2 million of debt in the first position to a local bank. And then we took out $2.3 million of equity from investors through a private syndication. So then I want to know, okay, where is all that money going? Is it going to some's going to the purchase price, some's going to expand the facility, some goes to project fees, and some goes to the operating reserve. So now I have kind of a 30,000 foot view of where all the money's going, where is it coming from, and what's the total. So this is, let's see, this is, I think, the overview of the project. I don't know if you guys have seen this, but I'm just going to do, oh, this is the closing video. So this is just a kind of a fly around of the facility in Corsicana, Texas. These are the part of the 11 buildings. I had a key padded gate access. I'm kind of talking here. There's 735 units of interior climate controlled and some outside exterior units. We're looking at the interior units here that are air conditioned, which is popular in Texas. Opportunity to expand 2 of it. And we liked all the ancillary income on this property. If you ever go there, it's really buzzing with activity. It's got a car wash, so there's people coming and going to the 5-bay car wash. There's people coming and going to the office to rent U-Haul trucks. There's people going there to do notary, FedEx, UPS drop. It's a busy place. And we like that because, not because we make a ton of had the ability to, make a place of convenience. Somebody like, we may not be, really killing it on the U-Haul rental, but we like the fact that somebody would go there to rent U-Haul trucks and then also be like, well, this is really convenient for my storage needs as well. So that's a little bit about the project. We'll jump back in here into the slide and let's see. So anyway, the next thing I'd want to understand is how that operator is going to complete their business plan. So, an operator might come to you and say, we're going to prove to me in your due diligence documents that you can do that. And so in storage, a big thing that the operator has to do no matter what is a feasibility study. And, if that operator is pretty sophisticated, they may be able to do it internally, or they might have an outside consultant come in and do a feasibility study, kind of like what's the growth rate in the market, how that operator plans to raise rents, where are the rents currently and how are they going to get to achieve those market rate rents, and if it's realistic. So when we took this property over, we did a feasibility study. This is kind of less important to the passive investor, but we did a 60-day due diligence period. And as a passive investor, you're going to want to know that the operator's done an environmental phase 1 study, potential components to this business. You're going to want to know that they bored holes in the ground and they studied what the dirt was in the soil. And they want to make sure that you're not building on something that is environmentally hazardous. And if they are, might not be a big deal if they've reconciled a way to mitigate those problems as done in due diligence. Get in the habit of asking for those due diligence documents. Is it a FEMA flood zone? Has it been environmentally tested? Has it been geotech? Is there a survey? Let me tell you about the deal that I did where the operator, I invested passive to the timeline of the project. Yeah, 4 years late. So, you think your operator knows what they're doing. Sometimes they don't. And sometimes you need to make sure that they have done the due diligence. And, if you don't have a boundary survey done and you don't be rightfully theirs, that's a bad thing. And if they're unwilling to spend the money on a survey, that's a telltale sign that it's time to run the other direction. So, kind of get familiar with all the things that the operator has done in due diligence to get that, warm and fuzzy that the property has been gone through. An easement check on the property. Title review is huge. When you go through a property and you go through the title, you're going to find things like easements. And I'll talk about the easement that we found on this property that wasn't a big easement or anything like that. So if there's construction or any type of component where they're building, you definitely want to make sure you have these things at a minimum: survey, environmental, geotech, easements, and title review. It's or buts about it. In Washington, if you're doing a development deal, you want to make sure that they've done a critical area study to make sure that there's not any wetlands and things like that. So let's kind of dive into the market feasibility. So we looked at what the physical occupancy was across all facilities and operators' due diligence documents. You want to make sure that they've assessed their competition. And this is especially critical in storage, where you want to make sure that they've gone and knocked on the doors of all the storage facilities in their local, hyper-local market and understand where their facility fits somewhere in the middle of the pack, so that when you're looking at occupancy and rents, you're comparing apples to apples versus, they may say, hey, my little crappy storage facility is going to achieve the rents of, that brand new extra space that was built down the street, that Class A extra space. Well, guess what, guys? It's not. It's not going to hit them, and they're comparing it against an A building. And, they may have to throw a lot of money at their property to get it even anywhere close to that property, and they don't have the capital improvement budget plan to do that. So then underwriting, this is a big one. I kind of like to show this slide just to kind of like show the fact that there are just so many units, especially in storage or big multi, how the opportunity that I found in this deal was that there was a gap between what the current owner was charging and what the street rates were. So, for example, if you're charging $30 a month for a storage unit, but you're charging, your property is 60. Well, and then the guy down the road is charging 75. You have a massive opportunity, so long as that facility down the road is comparable or can be comparable with a little bit of elbow grease on the property that you're buying, right? And now you can say, wow, I can go from $30 to $60 a month and know that I'm still going to be priced competitively within that market. So, and say, here we're just going to focus on just one storage type. So in this case, we looked at 5x10s, and 5x10s. If you look over to the right, you'll see that one unit was $23.50, one unit was $24, one unit was $26, and so on. But at the bottom, you'll see that 67 customers are. So we looked at all of the unit types and went, oh my God, there's $165,000 a year gap between what the current rates are at the property and what the street rates were. That's a huge opportunity, because if you take $165,000 a year of NOI and divide it by a 6 cap, you're talking over $1 million of valuation just in raising rents. So there's a real good, opportunity to raise just to raise these rents. Sure, in your mind that you've reconciled the fact that the operator will be able to do this based on the market climate. How full are those other properties? What are those other properties charging? What is the quality of those other properties, right? There might be, you can't just do a desktop view of this as an operator. You've got to go there and you've got to physically inspect all these properties. We just bought 4 storages in East Texas, and I think the team looked at 96 property buying as a competitive measure. And there's so much that you learn from just studying that market. So just in this example, we found 19 5x10 units paying less than $35 a month. And again, the street rate was 47. The market rate was like 55. So, there was a huge opportunities just to raise rents in that one unit type. And if you could imagine, we have 700 units. Just imagine if we raised the rent $10 a month on 700 units, that's $7,000 a month. That's $84,000 a year. That's almost $1 million of valuation right there. So this gap in rent over hundreds of units is a big deal. You go, okay, that's the gap. $165,000 is the gap. But now you look into the underwriting file of the operator, and you notice that the operator only underwrote raising it $72,000 a year. That's called conservative underwriting, right? You've reconciled that they're taking the $165,000 number, they're slicing it in half and saying, we're going to only raise it $72,000. And obviously nothing can happen overnight. You're not going to just snap your fingers and raise the rents. We tend to do that. Right when we take over, we tend to hit the ground running and within 30 days, because you have to give 30 days notice on a 30, because it's all 30-day leases, and you've got an increased rent. And how long are you giving yourself to raise the rent? So in this case, we gave ourselves 18 months. So that's about $6,000 of cash flow, and that's about $1 million of value when you consider targeting. Then the next thing we did as operators is we had a civil engineer to maximize the site plan. You might want to ask your operator, oh, you're going to build additional units. Who's your civil engineer? If they don't have a civil engineer, run the other way, because, and if you don't like the answer, then you should, that should be a red flag. So we use, in this case, we use a company out of Colorado called Brightlighter. They do a lot of our properties, and then we have a civil engineer in the Washington market. And we have civil engineers that are based, where we're based, but they're licensed, right? So they figured out that we had 39,950 square feet of expansion possible. And if you look at this map here, and for those not looking at it, imagine a square, and you've got this easement that basically cuts the square in half. This easement right here is a gas line easement that went through the property, and it basically the city the city owns the utility easement, and you can't put any permanent buildings over it. You can drive on it, but you can't put any buildings over it because they have the right to access that easement. Then you've got to ask what the stormwater requirements are. Again, a civil engineering thing. So we have this little pond here. It's triangle shaped in the corner. That is where we have to retain stormwater. So the 2 buildings over here, building A and B, make up the 40,000 or so square feet that we had it possible. And you notice we have a little red line going through one of these buildings and 20,000 feet delineated. We basically underwrote that conservatively and said, hey, we can build 40,000 square feet. Our market study says we have that much demand in the market. but we're only going to put 20,000 square feet in our pro forma. Estimate how much we can actually build, because you never know what happens. Maybe another facility might open up down the road, or maybe the costs come in too high, or for whatever reason, we like to just conservatively estimate how much we can actually build. So in this case, we said 20,000 square feet. The picture that I showed you at the beginning of this presentation, actually, we ended up building 40,000. So we have 40,000. So you got to be realistic with when will the building start, right? So if the pro forma has the buildings coming up the first day you buy the property, again, that's just highly unlikely. We gave ourselves a year in the pro forma to start the construction. And then we gave ourselves another 6 months. This in April of 2019. We broke ground in about June, and we'll be open in January. So we're on time based on the pro forma. We're not too far ahead. We're not too far behind. We're pretty much right on the target. And then once we build, you don't fill the place up with customers all at one time. It takes time to lease up. So is the lease up realistic with your expectations in the market? So we gave ourselves 15 months to lease up 20,000 square feet. So not too bad. So this achieves about $155,000 a year of added income. And if you do a valuation at a 6.5 cap or 6.6, that's about of construction. So not bad. Some questions to ask your operator is, hey, who's doing your construction? What company? How are you financing this? What experience does your contractor have building storage? What experience does your contractor have building storage in this market? What are some comparable buildings that they've built? Project management. So, if an operator is building something, you're going to want to have somebody paying attention to what they're building. I know you could just say, well, my contractor's doing it, but who's keeping tabs on the contractor? So in our case, we have two people who are pretty much full-time in the construction management, Scott Lewis, our CEO, and then Garrett Van Manen. Garrett is a licensed contractor. All of the construction that our properties are doing. For example, every construction project that we have has a weekly, we call it OAC meeting, owner, architect, contractor meeting, where the owner jumps on, or the owner's rep, which in this case is Garrett as our project manager. And he goes through meetings with our contractor to make sure. We also have cameras on all of our construction sites, as you saw earlier. So get a feel for how your operator is going to be managing the construction. And just giving it to your general contractor is not good enough. You got to see some type of plan or hear about. So this is kind of fun. This is the. I got to jump over to YouTube again. But this is the foundations going in. I think we showed this at the last meetup. But this is the project getting graded, the vapor barrier going down for the concrete, and then the foundations going in. So kind of a fun shot. And actually, I don't know. Oh, that's it. I guess that isn't the one with the concrete, but there's another video we have where the concrete goes in as well. But some of the grading and the things going in there. So all in all, kind of understanding your business plan here. We're planning to raise rent $72,000 a year over 18 months based on some good market data that we went out and studied. We plan on adding 20,000 square feet, so $155,000 a year increase with the facility expansion. And when we bought the facility, it had $443,000 of existing NOI. So add all that's our projected sale date. We'll have $670,000 a year of NOI. And at a 6.6% cap rate, that gets us to a $10.151 million purchase or sales price. So kind of everything that I've said so far is the level of understanding you want to have going into a project. You want to understand and sort of go through that in your head and at least conceptually understand how this is all going to get done. And then you want to go through and you want to really understand that they've done the due diligence and the feasibility required to do this. So the next part I want to talk about is what documents you should see. So usually whenever you do a deal, you're going to have something called the deal room. And in the deal room, you want to minimally see these documents. Now the last line there on Form D, Blue Sky filings, that's not a document you want to see, but you want to make sure that that's been done. That's kind of a different discussion, but you want to make it and you want to read every single word in it and you want to understand what those words say. And we'll kind of dive into that in a minute. You want to see the offering memorandum. This is the sales pitch. This is the slide deck that you see, right? And just to kind of, beat up on an offering memorandum is absolutely worthless. This is their opportunity to sell you stuff. Operating agreement and the private placement memorandum. So if you're a sophisticated operator, you're a passive investor, you're going to look at the offering memorandum and say, okay, you're going to spend about 30 seconds on it and go, yeah, I kind of like this deal. I like that market. I like the operator. Returns are okay, whatever. And you go right into the operating agreement, private placement memorandum, because that's where the the deal happens. That's where it tells you how you're going to get paid. It tells you the rules of the road, what the operator can and cannot do. And quite frankly, that's where a lot of shenanigans and ridiculous stuff happens that you want to suss out to make sure that you're on the right path. The purchaser questionnaire is known as an investor, kind of proving to the operator that you know what you're doing and that you're sophisticated. And then the subscription agreement is what tells the operator that you've read all the above documents. So if you sign in a subscription agreement, that's usually anywhere from a 3. I've read everything and I understand what I'm doing and I'm signing up for it and I'm subscribing to the offering. That's the offering doc review. So kind of getting into the, I kind of stressed on the operating agreement, the rules of the road. So what are you looking for, right? And my kind of myself, and I want to know how I'm going to make money. So the offering memorandum has this section typically in our deals that breaks out how much money we're going to distribute to you from a projected basis and how much money you might earn in a liquidity event. Liquidity event means a refinance or it means sale. So if you look at the bottom left there, I've got operating returns in year one at $2,998 projected. So that means that from opting that to an investor on a $50,000 investment, there's a bunch of numbers above that, 8% preferred return, 1.09% ownership, things like that. But really that's what we expect to get from operating returns. Then you might say, well, when do I get those operating returns? So you want to go to the operating agreement because again, that's going to tell the rules, and you're going to want to look for distributions from operations pulled out, and this is also in the PPM. And it says distributions of net distributable cash flow being cash available less all expenses and reserves as determined by the manager in its sole discretion from operations, if available, shall be made in the following order of priority. And it says for preferred return balances until each such member's preferred return balance is reduced to 0. So that basically means you're Class A. So the first thing you want to do when you pick up the operating agreement, the PPM, is go, who am I? Am I Class A? Am I Class B? Am I Class C? Am I Class Z? Am I Class whatever, right? Whatever. Now, whether you're Class B or Class A doesn't make a difference, right? They could call you Class F, and it really makes no difference to anybody. So in this case, the passive investor is Class A, and the operator is Class B. Just the way that we did it in this one. And it says you're going to be paid based on your performance. Well, if you look at the definitions, it tells you in the definitions, preferred return balance means with respect to a member at any as a given date, the amount of additional distributions, if any, that such member would need to receive under this agreement on such date in order to produce on such member's total capital contributions. So what that means is 8% on your total capital contributions. Okay. So if you have a capital contribution balance of $50,000, 8% of that is $4,000 a year. Next line, it says, which will only accrue from the date at which the capital contributions were actually contributed to the company until the date at which such capital contributions are returned to such member. And it shall be calculated as simple interest. So the impact of the interest in your capital contributions, your preferred return account balance in this instance, doesn't start until you hand the operator the money. Right? Sometimes it starts when the deal starts. Sometimes it starts when the deal closes, but I'd have to check. So the preferred return is defined as cumulative here. And in definitions, it's saying that it's cumulative, right? So before the operator, because the second step is in the distribution, percentage interest. So basically this waterfall is very simple. It basically just means that they're going to be giving the money to the passive investors. And so their preferred return balances are paid off 8%. So let's say in year one, they only get $3,000 on 50. And in year two, the operator makes $6,000 to give out per 50. Well, guess what? They have to pay the $1,000 that's accrued in a balance from year one. And then they can split $5,000, after $4,000. Preferred return account balance has to be paid down, and it's cumulative. And so that's what you took away from the operating agreement. Now, let's just say you looked at the offering memorandum and it said it was a preferred return of 8%. Well, guess what, guys? They could define in the operating agreement that it only accumulates annually. And how would you know that? You would only know that by going to the operating agreement. What I have on the left side of the screen is just what's in the sales pitch, right? It's in the sales package, and it just says preferred return 8%. It gives no other description on what that actually means. Right? First year, some operating agreements can be read that or be structured that, well, you didn't get it in the first year, but it's not cumulative. It goes away. And then in the second year, it resets. So sorry you didn't get it in the first year. Even though if we make $5,000 or $6,000 in the second year, we're not paying you back for the first year because it doesn't accumulate. right? So return account may have compound interest. So you may earn interest on the unpaid preferred return balance. That would be even more beneficial in what's presented here, right? So there's a lot of different ways an operator can define this agreement in the PPM. As a sophisticated investor, this becomes very important. And my recommendation is to, have your, kind of have a syndication attorney, or maybe even your just kind of advisory, kind of understand this, kind of look at it, spend an hour on it, and just make sure if you're going with a new operator, or the operator doesn't have the answers to these questions or can't point to where it says, to understand that. So sorry to go so long on this, but it is kind of a big deal. It can make a lot of different deals go differently. Okay, so let's talk about what happens when there's a refinance and liquidation. So this is, let's know what your waterfall is and how you get paid. So in this case, first it goes to Class A members, that's you, in proportion to their cash capital contribution balance, right? So basically what that means is that any money that you have on your capital account balance that you've given to the operator comes back first until you got that reduced to zero. Then it goes to any Class B units in proportion to their capital contribution balance until that cash contribution. Just say here, I'm saying that the passive investors are going to get paid back entirely before the GP has any invested money returned. So let's say the deal completely falls apart, but they sell the deal for enough profit to get the passive investors' money back, but not the GP. Get your money out of the deal before the GP does. That's pretty strong. Third, to members holding Class A units in proportion to the respective preferred return account balances until each such member's preferred return balance is reduced to zero. So the next step in the formula is to pay off your preferred return balance. Let's say this deal went 5 years and there wasn't $1 earned, and now you invested $50K, so every account balance, and the property sold and made $100,000 profit. Well, guess what? Your preferred return balance gets paid first before any splits occur. So that's really important to know, because you're going to get your 8% before any upside to the general partner. Next is fourth, to members holding Class B units, so that's the GP, in proportion to their total non-cash contribution balance until that's zero. What that means, and we've actually pulled this out of future offerings, is non-cash contribution. So for example, every one of our new properties, we send a computer down there. So we've got laptops in circulation, and so we get those laptop back. We might sell it with the property, and then lastly, the members in proportion to the respective percentage interest. So all the investors get their money back, then the GP gets their money back, then the passive investors get their preferred return account balances paid off. The company gets their computers and equipment back if they've put any Spartan or operator-owned equipment, gets the split. In this case, the ownership was 1.09% per 50. So if there was $100,000, you'd get 1.09% of that distributed cash if that's what was left over at the end. So that's basically what happens if there's a refi event or there's a sale, and this agreement / PPM. Here's a bad language example. So you start getting into these deals, and the deal starts going bad. And this is a deal that I'm in, unfortunately. Hopefully there's no, okay, good. So I just want to point out that there's snakes in the grass, and there is really bad, give the general partner or the partnership so much authority that they can do things that are not good. I want to draw your attention to paragraph H here. So it gives the company the right to invest a specific deal in government securities, certificate of deposits, bank acceptances, commercial loans, or similar investments. So what this gives the operator the authority to do is take your money in this deal and pretty much go do whatever they want with it. At least that was their interpretation. Now we'll see where this goes, but that's a really bad line. I would not in the future, if I had this in a PPM, or because basically the paragraph 8.1 says a lot of stuff like exclusive and complete authority, discretion to control the business, put your money in different securities, deposits, acceptances, commercial loans, similar investments, etc. What this operator ended up doing was he lent money from the project that I invested in a completely different project that he controlled, right? And that paragraph H was his interpretation of his ability to do that. Now we'll see how it all. There's little snakes in the grass, and there's little I gotchas, tripwires in these PPMs that give the manager a lot of authority. So make sure you read the PPM and operating agreement. And as friends and as a fellow investor, I'm happy to read your PPMs and your operating agreements, and I'm happy to help you understand what they say and what they give you and what they don't give you. So let's talk about depreciation. Everybody knows I'm not going to have a big chat about bonus depreciation, cost segregation, but this property came with $1.7 million of depreciation. You can go take a course on that. What does it mean for a passive investor? Here's a K1. This is the real K1 from the deal. So let's talk about what this actually means. So here's the investor. I've got them, hopefully I've got everything blanked out here. And they invested $50,000. They took a loss of $21,745,000 in the first year. That's awesome, right? And then you'll notice they have an ending capital account per the IRS of $26,069, and they earned distributions of $1,643. They made tax-free income. So this box 1643, that's cash in pocket for the year of 2019, and this is the net loss. Where is it at? 21,000 is their loss for the year. So I think is a big hot topic, but what happened the thing that he did, to pay $750 of taxes is not uncommon as a real estate developer, real estate investor, passive investor, because in real estate, because you get these big losses from real estate. Now, the next year, this deal is performing at about a 9% per month distribution now. So this investor will earn, call it $4,000 in 2020. They can use the remaining 21,000 or so they have in this year to cover and shield the taxable distributions next year as well. So anyway, this is the K1. This is what you get when you're in a passive syndicate. Question to ask your operator is, how do you split up your depreciation? Do you split it up based on equity ownership? Do you give it all to the investor? Do you, split it between LPs and GPs? How do you break up the depreciation? And guess what, guys? It's all in the operating agreement in PPM. I didn't have enough time to pull out the language, but it does talk about taxes in your operating agreement PPM. So it's a great thing to send to your CPA and say, hey, Mr. CPA, what kind of tax losses will I give you a good answer? In our offerings, we tend to like to show what the tax losses will be, but they're all just projections and estimates at that point. Typically in storage, we can depreciate about 30% of the purchase price depending on the deal. And that's a range. It's a projection. Now, the big question I have, for my operator is, when do you guys send the K1s? Your taxes by April. Maybe you're expecting a big loss and you want your tax return done. Is that operator going to give it to you on September 15th, which is the business deadline for extensions? Or is he going to give it to you in March and give it to you on time, right? We put in our operating agreements that we shall provide K1s and tax documents to members no later than March 15th of the following taxable year. So we put it in our operating agreements. So let's talk about capital contribution balance really quick. I know this is boring. I'm not trying to put everybody to sleep, but it is important. So this is the money that you invested, $50,000, right? And this is the IRS losses. So for the IRS purposes, you've only got $26,000 of capital contributions. Now, that distribution that we sent you in this deal, 1643, that was profit. That was profit. That was return on investment, right? That was actually money generated from the profit of the business. And I know this is kind of a funky conversation, but some operators will overraise and send back a return of capital. It'll still come on your K1. It'll still be taxable income. It'll still be listed as a distribution. And you'll still have this. But your question is, well, what's my actual capital account balance from the operator's perspective? So in this case, we just started doing investor statements for our investors. So we provide that information. Total capital invested, $250,000. That's the original. And you can see we have outstanding capital balance, $250. So in this case, if it's $250 and $250, the operator has not given you back any money. We talked about sending back your full capital account balance at the end. So some operators may be dripping money back to you in a return of capital. And when there's a liquidity event, you're not going to get back your $50,000. You're going to get back $50,000 minus whatever they've given you throughout the deal. So I always ask the operator, do you do a return of capital? Or are you actually providing us a return on investment? To investor statements now, because we like to show investors that you put in $50,000, your capital account balance is $50,000. This is the distributions that you've had. And this is our new investor statement that's coming out this quarter. So you can see this investor has invested $250,000 across 3 projects, and distributions have been $16,960. They still have a full capital account balance to return when the assets sell, and how much money they've made in the current period. So just kind of something to think about. Are you getting capital returned to you, or are you getting a return on your capital? Two very big differences in offerings. This is how we do investment updates. We send these out every quarter. Ask your operator. I didn't have time to put this in the slide, but ask your operator, when do you do how often do you update me? When do you update? What's your every month? And then we do an investment update every quarter where we show revenue, expenses, NOI, and distributions, and we show a pro forma line versus an actual line to show the actual performance of the property based on what it was supposed to be and what it actually is. And this gives an investor a really fast way of understanding because me telling you that the property is 92% occupied is really meaningless against what it should be based on your projected business plan and how that impacts my return and my performance. So that is all we have. So thanks for listening. And